outlining something like mathematics to them. So let me assure you, all of you, that what we will do today will largely be very basic, which means that the mathematics that I'm talking about is not even high school. It is probably middle school mathematics that you need to know. But I wanted to give an idea to all of you about a couple of things. One is that we tend to ignore this part of our life till it is too late. So to give you some, well, not so exciting news, is that if you have waited for close to retirement to think about your retirement, it's already too late. There is very little you can do about it. The best time to start about planning for your retirement is as soon as you start your work. Because money really builds on money over time. And it is not instantly that you can make money. And we all know how long it takes to make any money at all. And if you are seriously thinking of generating wealth, now I'm differentiating small amounts of money with the word wealth, which means wealth is a significantly larger sum that we're talking about. And if we want to generate that, there are various ways and means to do it. And the least understood, to my mind, is ownership of equities, ownership of companies, which is the best way to accumulate wealth. But the fact is we don't know anything about it. We get interested in it because we either see TV and we see other people make huge amount of money overnight, and we get attracted to it, and we lose a lot of money in the bargain. So there is really no way that we can attempt to even indulge in this activity unless we have some basic understanding of how this all works. And even after a lot of people have spent a lot of time in these markets and they call themselves experts, it is really very difficult to make any prediction whether you will make any money at all or not. So you can understand that this is a very difficult subject, not scientific in that way, because science deals with precise measurements and formulas, which eventually, when you apply them, come to a certain conclusion. Finance and the economy in general, which is to deal with people and behavior and their emotions, are very difficult to make into any formula. So the formula will not get you there, but where you are, you can explain by way of formula. So it is always backward looking. There is always an implied understanding rather than a forward looking understanding. But many people make that mistake, saying that if I have the formula, then I can see if the future, but the future is not really like that. So that's a little bit of a background in terms of what we're dealing with. Now, what I have for all of you is a brief presentation, and which I will take you through some of the terms that we hear every time, either when we open a newspaper or when we hear TV and people discuss about these concepts. So in a very, very short way to explain to you what those concepts mean. And after I take you through that, then I will come quickly to the concept of valuation of companies, which is something to do with the stock market and something that we all are interested in. But again, the paucity of time and the fact that these concepts have to be introduced to you for the first time, I will reserve my judgment about how much you can get out of it. But at the same time, I'm just happy that you will hear me out. We will go through the conceptual framework. And then if we have some time, then we will do a Q&A. But I can assure you that this is not the end of your education. If at all, it is just the first step, maybe the first kindergarten class that you will attend of a subject which is very, very encompassing, very engaging, and very, very profitable if you really, can apply your minds and energies to it. So with that, I'm going to share my screen to start a brief presentation, which will take us through, these concepts. So let me begin with this slide, which we may have seen in the recent past and wondered about a lot. On the right-hand side, you see the headline in the Economic Times, which says that COVID-hit economy may have shrunk 14 to 26% in the Q1 of the financial year. And the financial year begins from April of the year and ends on March 31st of the following year. So the first quarter will have ended in March to June. So 30th of June, these 3 months, the Indian economy seems to have shrunk anywhere between 14% to 26%. It's a huge, huge drop. Generally, this number on a real basis every year is somewhere between 5 to 6%. And that is a positive 5 to 6%. Now compare that to what we have just seen. So when you hear something like this happen to us, that the COVID hit economy is going to shrink so much, it is going to come down. What we see on the other hand is the third point that we have seen since probably May of this year, where the stock markets seem to be going up and up. And many times we believe that where the economy is going and where the stock market is going should go all together, right? Because if the economy is doing well, the stock market should go well. If the economy is going down, stock market should also come down. That's the logical thinking, right? But today you have a situation where the economy is going very much down, but the stock markets are going up. So there is the first question that doesn't make any sense to a logical person. So the slide talks about GDP collapses, interest rates lowered. Now this is another concept which at our ages, and I'm very sorry for the photograph that I advertised myself with. This was a photograph taken about 12 years ago. But to be fair, as we get older and as we reach probably the end of our working life, we start worrying about interest rates because of our savings that we are keeping with our banks. The higher the interest rates, the better for us, right? So that's our basic understanding of interest rates. But I want to give a perspective of how these things really have a lot of interplay between them. So all of the 5 points or the 4 points that I have, and I'm asking the 5th point there as a question: GDP collapses, interest rates lowered, stock markets boom in spite of COVID infections reaching new highs, and Jeff Bezos, who is the richest man in the world, has just crossed net worth of US dollar $199 billion. So does that all make sense? Does the world make sense? What's happening? Not only in India, but all over the world, the GDP is going to come down. People are facing lockdowns, which means they are unable to go to work. If they're unable to go to work, how are they going to make any business? How are they going to make any money? How are people going to get paid? Because if you don't have any business, how will you pay your employees? And that's the reality. But if that is the reality, why is Mr. Jeff Bezos, who owns, by the way, the largest share of a company called Amazon Inc., which we all use for delivery of things that we order from the net, and that company, by virtue of his holding of this company, by virtue of his ownership in that company, has made him the richest man on earth. Now, does that all make sense? Should he be making money when the rest of us are going to be worried about, our livelihoods? From a moral sense, but that's the reality. And how does this happen? And how is it all related to interest rates? How is it related to the GDP falling? And I think this is something which we'll try to find an answer to the end of this presentation. If you have some inkling of the answer by the end of this session about how these are related, then I will feel my presentation is successful. That's my basic attempt. So let's jump into the main concepts. I'm going to be a little quick in the interest of time, but please hold me for any questions later on. So let's start with some concepts. We all keep hearing about this word GDP. We just heard about it recently in the first slide. GDP is falling by 26%. What does GDP mean? GDP, in other words, means the total sum of all goods and services produced in a country. So for example, if I'm producing cars, if I'm a Maruti, I produce cars and I sell them at a certain price, all the number of cars that I sell at the price that I sell is going to be my sales number, that I sell so many cars at this value. And well, I total that sum is the total sum of the goods produced by Maruti for that year. Now I add up all of the companies in this country, all of the enterprises in the country, and I add that number up. What are the sales of each of the goods that you produce? And then of course there are banks. So banks, for example, don't sell us anything, but they either accept our deposits or give us loans. They also have a sales number. They also have a top line. If I add services, because they're selling us services, they are not selling us any goods. If I add the services and the goods together, and I come up with a number for the entire country, I come up with what is known as the gross domestic product. Now that tells you how big a country is. So to give you some numbers, the Indian economy size by GDP is about $2.3 trillion. Okay, $2.3 trillion. Compared to that, the Chinese economy is around $7.5, $8 trillion. So it's clearly about 4 times our size. If you look at the US economy, it is roughly around $14 trillion. So you can imagine how the sizes of these economies matter. And then there is this concept of, then you'll suddenly start saying, oh, India is so big. But you have to remember that there is something called as a per capita GDP, which means that this total number that I say, if you divide that by the number of people in that country, the population of the country, you will say how much of a share of that GDP does per person contribute. So obviously now the population becomes a problem. So if you have $14 trillion in the US population is around 370 to about 400 million people. So you can imagine that divided by that becomes the per capita GDP in the US, which is fairly high, which is roughly a number close to $30,000 or something like that per person. In India, the same number is, because of our population being so large and our GDP being probably 1/8 of the United States, our per capita GDP is only about $2,400 to $2,500. So that is the measure of how rich a country is, and that's why the GDP number is looked at very closely. Now, why are we then concentrating on the GDP number? Is because more the GDP increases, more is my wealth as a person, as an individual, that I can display to the rest of the world. So GDP is very important. Some of the poorer countries are much smaller in GDP size. The UK, for example, is just a little tad about $3 trillion. So by GDP, the UK and India are almost the same. But because we have so many more people, the share of the GDP per person is much lower. That's why we are a poor country or relatively poor country to the UK, where the population of the UK is hardly a percentage of ours. So, but they have the same GDP as a top line. So this is our first introduction to mathematics, denominator and numerator, so you can understand how these concepts are used to identify certain economic concepts. So while the mathematics is very simple, it gives you a good idea of wealth, of how to define wealth and wealth of nations, and how per person wealth can be measured. So that's the first concept. Inflation, I'm sure you must have heard about inflation. That's the other concept that we need to be worried about, because inflation is the rate at which your purchasing power is going down, the rate. Now, what does that mean? For example, if you remember, in fact, my mother keeps telling me all the time that, vegetables have become so expensive these days. In our time, potatoes would go for, 5 rupees or something like a kg. And now potatoes are 20 rupees a kg. I keep telling her that actually potatoes have become cheaper because when it was 5 rupees a kg, you were not making so much money that you're making right now. So your purchasing power has actually grown over this time. So you can afford whatever the 50, 60, now these days, sometimes it goes higher per kg of potato that I'm paying for. But she doesn't understand that because this concept of inflation is not there. So inflation is something to do with purchasing power. How many things can you purchase today with the same amount of money, and how many things you could purchase in the past with the same amount of money? And what tends to happen is inflation goes up, which means you are able to buy less and less if the inflation rate is higher, because it is inflating the cost. Now, which means that vegetable prices actually have deflated over this period of time. That means I have more purchasing power, but certain things have become inflated. So ma'am was just talking about kindergarten and the cost of kindergarten. Now, what was kindergarten cost when we were in kindergarten? Probably there was hardly 10 rupees or something per month. But today, kindergarten is very, very expensive. That is real inflation. which means that the cost of education in this country has inflated at a rate which is much higher, much higher than what has inflated otherwise. And this is why inflation is very important to track, because it depends on my ability to spend in the future, and it depends on what inflation is going up. So food inflation, if it is going up, I have a problem if I'm very poor. But food inflation, if it is in line with my earnings power, and if my earnings power is higher than inflation, then I'm comfortable, then I can afford food. But can I afford other things? And that's how interesting this becomes. Again, numerically, I wanted to make this a little more mathematical oriented. What is inflation? We all know that inflation is a number, right? A number which is published in the newspaper. Today, if you look up inflation, it will come up around 6%. Now, what is 6%? 6% is expressed, inflation is expressed as a rate of rise in prices over the same price last year. Now, if you take one commodity, that is not inflation. The inflation is an index of commodities, which means it will include food, petrol, all the things which you require for normal usage. They add up that list, and then they express inflation as a percentage of that price rise of these baskets of commodities over a year. So for example, if I give you one commodity, potatoes, for example, if you've taken potatoes, if it was 40 rupees last year, and today I'm getting it at 44 rupees, inflation in potatoes by this measure is 10%, because it is 4% over 40. So 4 rupees over 40, which makes it 10%. But is that inflation? So 6% then represents the CPI, which is known as a consumer price index. Even the indexes are different. Consumer price index is a basket of consumer products. So for example, milk, basic items that I require, say maybe petrol, diesel, these are all personal consumption items. So the consumer price index is made up of personal consumption items list. So then I know as a consumer, that's my inflation. But if I'm a wholesaler, suppose I deal with raw materials, and especially companies are looking at wholesale price index because they want to buy products in bulk. Now, what is the change of bulk commodities is what they are interested in, because that is their starting price. So when I buy raw materials, then I produce finished goods, then the difference between that is what I make. But if the raw material prices are going much higher, then my margins will be low because I will be unable to sell it at that same higher price. So the wholesale price index is more interesting to consumers of industrial goods and of larger quantities. So the WPI used to be the measure of index of inflation in the years past. In India now, we have changed to consumer price index. And this happened when Mr. Raghuram Rajan became the RBI governor. At that time, he said, look, why are we looking at wholesale price index? I'm a consumer. Largely, Indians are full of consumers. So we should look at consumer price index. So consumer price index today is around 6%. The wholesale price index, on the other hand, is actually only 2%. So that's the gap you can see between these two indexes. So again, just by way of giving you some idea of how it is measured, what does that mean? And hold to that thought about what inflation means, because it tells you at what rate your purchasing power is eroding. So for example, if the inflation rate was 0 and I made 100 rupees last year, then today also my purchasing power of 100 rupees is 100 rupees because the inflation is 0. But if the cost of commodities have gone up by 5%, as what we are discussing here, if the consumer price index has gone up by 5%, then next year, in last year's amount of 100, I can buy 95 rupees worth of goods or services. You can tell where the gap has happened. So if it is 5%, then that is by which I have eroded my ability to purchase the same things that I could buy last year. So you can see time, over the time horizon, you are eroding your purchasing power at the rate of inflation. So it is an inverse relationship. Again, a little bit of mathematics. Again, I say the mathematics is extremely basic, but it helps us understand what this is all about. So if the rate of inflation is high, my corrosion of my purchasing power is higher, which means either I have to make more money next year to just remain at the same level, or I have to control my inflation in some way. Now, practically all of you are income generators by way of salary. Now, how many times do you get an income salary hike? It's a very dangerous and sensitive question I'm asking. But if your rate of salary increases is not in line with the rate of inflation, what will you experience? The basic economic concept, you will experience scarcity, which means that increasingly you will find life tough to undergo because your purchasing power is eroding. You are not making that much more money, but the cost is going up. And that is what is indicated by inflation. So inflation is a good number to keep track of. So when you look up inflation numbers tomorrow in the newspaper or keep track of it from here on, understand very well why we have to do that. Because if inflation is going to be very high, I have to be worried. I have to be worried that unless my salary goes up or my investments keep in line with that, I will experience a contraction of my lifestyle. I will not be able to afford all the things I could afford even yesterday. And there are concepts such as double-digit inflation and galloping inflation. Some of the countries in Africa, for example, experience super inflation, where suddenly the value of that rupee collapses overnight. So that leads to another crisis. And there are very large economic reasons for that to happen. Thankfully, we are not in any of those basket economies, but we have experienced double-digit inflation. For example, some of you may have noticed that in the 1970s, it was 3 years into my birth in this world, India experienced severe inflation, which was not only in India, but all over the world. It was due to the OPEC being formed. So the Saudi Arabian nation formed a coalition of oil producers, and they decided that they will push the price of oil high because it was a monopoly, and it collapsed the entire economy all over the world. And inflation, because it is a basic commodity, you use oil and petroleum products for everything that you do. If that price goes up, everything goes up. So the whole world became very inflated at that time. So that was one experience of very super normal inflation rate hikes, which led to very high interest rates. If you remember in the 70s, in the domestic banking system, you could get a deposit for 15%. You remember that? 15% because the inflation was also very high, which was almost 12 to 13% at that time or even higher. Now, to keep in line with inflation, your interest rates have to go up. Today, what are interest rates? For example, in the US, interest rates are zero, and inflation is also near zero. So you can see a relationship between inflation and interest rates. And so now going back to the first slide, try to remember what the slide meant. What have interest rates got to do with GDP? What has interest rates got to do with inflation? So these are all interrelated concepts. Very interesting from an economic perspective. Interest rates. Now we come to interest rates finally, and what are we talking of? So there are two interest rates that we largely think of in economic terms. One is called the real rate of interest, and one is called the nominal rate of interest. Essentially, very simply and in mathematical terms, the real rate of return, or let's say the real rate that you make out of anything, is the nominal rate minus the inflation rate. So for example, if you say that I went to the bank and the bank told me that you can have a 2-year deposit and the rate is 4.5%. Today, you will probably get this rate. Now, you're happy, oh, I'm getting 4.5%, but the inflation rate is 6%. We just opened the newspapers and found out that my inflation rate is 6%. And that's also an average. It is not even my particular inflation. For example, if my lifestyle is very inflationary oriented, or I buy only inflation oriented products, then my inflation is much higher. But as an average, it is 6%, which means that I'm getting 4% interest, but I'm losing purchasing power at the rate of 6%, which means I am a loser of 2% in real terms. So this concept called real rate of interest is very important because that tells you whether you are actually making anything at all. If you are not making something higher than the rate of inflation, you are actually losing purchasing power, which is where I told you earlier that if you have to generate wealth, you cannot generate wealth by putting the money in the bank. You have to take a lot more risk for generating money, but that's what I was saying. So for us as individuals, we just have to be helpless. We have no other way because otherwise we don't have either the expertise into going into the equity markets or taking more risk in some financial assets. All we know is fixed deposits, and fixed deposits are determined by the bank. Inflation is determined by the entire economy, the growth or lack thereof. So which means I'm always a price taker. I never command the price. I don't demand that my interest rate should be high. And in fact, interest rate should not be high. That's also another problem which we don't understand. Okay. I hope I'll be able to link those concepts. Maybe it's a little too far in scope for today, but just to give you some ideas about how these things are linked. Now let's come to interest rates and how we calculate return. Okay, now we're getting into the meat of the presentation. So basically, to explain what simple interest is, it is what we get in the savings deposit. So for example, and some Greeks are coming up on the slide, so please don't feel threatened. They're not very dramatic. So I'll take the cursor to simple interest, how it is calculated. So suppose you have 100 rupees and the interest rate that the bank was giving you was 4%. So to calculate simple interest, I would just have to simply multiply 100 by 1.04, and I get what I get is interest calculated in a simple interest. But compound interest is something different, and it's very, very interesting because I'm sure as scientists you'll be very, very keen to know where this comes from. So compound interest is basically interest on interest. When you go on a multiple term of an investment, then that is where it becomes interesting. So what is the difference? So I'll take you to this example where you see two columns. The first column is interest rate generated at 10% per annum in a simple interest, and interest generated in compound interest in the next column. So let's take an initial deposit of 10,000 rupees, and in the year one you will get 1,000. That is your interest. In the year two you will also get 1,000 because you're calculating simply on the principal amount. So 10% of 1,000 is 1,000 only, and every year you will get 1,000. So at the end of the 10th year you will get 10,000 rupees totally in interest plus the 10,000 back. Simple. That is how most and all of the fixed deposits in banks or any fixed instrument works. It does not give you 10,000 to 20,000. It only gives you 10,000 plus 1,000 per year for as long as the term of the deposit is. Now let's look at interest rates of compound interest. So suppose someone is willing to give you compound interest instead of simple interest. There are not too many people who do that, but this is a concept, and I'll tell you why this concept is important as we go into equities. So here, 10,000 rupees, at the end of the first year, you will get 1,000 back. But if I'm compounding interest, by the second year, I will give you 10% on 11,000. Because I'm not giving this 1,000 away, I'm keeping it with me. So the difference between compound interest and simple interest is that I can take this 1,000 away in the first year. I will still make 1,000 the next year because it is calculating on this sum. Here, if I take the 1,000 away, I will also make 1,000 the next year. So this compound interest works on accumulated capital, which means I am allowing this. I don't want the 1,000 every year, but I want the rate of 1,000 to accumulate at 10%. And as a result, if I keep the 11,000 for 1 year, I will make 1,100 rupees of interest the third year. If I keep the 1,100 also, then I am adding 10,000 to 1,000 to 1,100, and I will make 10% on the 12,000 that I make. So 12,100, and of that 10% is 12,000, 1,020. Now here, as I keep adding, you will notice that the sums are getting bigger and bigger as they keep coming along. And interest now in the 9th year is the sum of all the interest sums received plus the principal. And now the interest is a very handsome sum. And by the end of the 10th year, I'm 50% higher, almost 59% higher as a total sum coming back to me than if it was simple interest. Now you will also ask me, where is this compound interest available? There is no bank which gives you compound interest. Okay, no bank which gives you any of this. There is nobody who will give you compound interest. But there is a way to compound your return in some other asset class. So this concept of compound interest was just to tell you how quickly this can generate. Now over 10 years, you can see there's a difference. What is the difference over longer periods of time? And this is something diabolical. This is something phenomenal. Now, this is why I was saying that the right time to think about retirement is when you begin your work life, not when you're ending it. It's the biggest learning today I can leave you with. It's a very depressing learning, but that is the fact. Now, if I had 40 years to save and I put that in a compounding investment, can you see the gap? There is no comparison. Now, I'll give you another example of someone who has been a very successful investor all his life, and he's written books and he's very, very popular. His name is Mr. Warren Buffett. He's also one of the richest men on earth. And he did not do a single job in his life. All he did was invest in stocks. That's his claim to fame. And he's one of the most successful. It's a rarity. You don't get many people like that. But it's his experience. And he has compounded at the rate of 13% to 14% for the last 40 years. He just turned 80, by the way. Sorry, he turned 90 and he began his investing career in his 30s. So you can imagine 50 years, if you compound at a rate, even a small sum can become a massive amount. Huge. I mean, you cannot calculate that. But what do you need for that? Something which compounds, not something which gives you simple interest. Even over the same period, if you had invested, you would just practically be here. The big gap between is almost a tenth of what you are trying to approach here. You can see the power of compounding. It is phenomenal. The problem is we don't know what are the ways of compounding our money. We only know simple interest. But we would like to know that. Right? So this is now coming into a little more interesting way, and now I'm jumping. So it is, you may experience a shift. If you did not understand much of what's happening here, you will not understand anything that's happening now. But I know you are all very intelligent, so which means that not only have you kept pace with me, now you are almost half an economist, and now we are jumping into being financial experts. Now here's the concept of finance. Now, how do you calculate return? Calculate return by looking at my ending value, and I divide it by my beginning value and multiply it by 100. It gives me the percentage return of any investment. Simple. We should be able to do that. Anything, for example, they promise you, Acha, from here on, you will get so much money when you get this thing back. That ending value, I divide by my beginning value, and for the number of annualization, I will do it. But just a simple return is that divided by this gives me my return. These concepts should be hard coded into your brain, the simple things. Now there is something called as I said, inflation. Suppose I go back here and I say that over the 10 years, inflation, assume inflation at the rate of 5%. Now what will change? Remember I told you about real return. These are what? Nominal returns. These are what is promised on paper. This is what you will get. But the 1,000 rupees I get in the 10th year, at the rate of 5% inflation, what is it worth in that 9th year? The future value of that 1,000 is much less than the present value of the 1,000. Is it not? That is the concept of inflation. Which means even if I'm getting 10%, then I'm actually getting a lot less than 10%. Because inflation has eaten into my return over this period of time. I have no way to increase this 1,000, no? It can only pay me the interest rate as promised. So you see how investments have to work to be able to work harder for you if inflation is going to be a problem. Now, if I were, say, for example, on the compound interest table, maybe I'm keeping in touch with inflation. So maybe this 2,000 is almost worth 1,000 in the first year. See how that changes? Which means if I have a compounding asset, I am maintaining the purchasing power of my investments. Otherwise, I'm losing. Every time I lose when I get into a fixed interest instrument like this. Because my interest is not going to keep in touch with the inflation. And the longer this is, the worse it is. Why? Because in the near term, they're almost the same. Up to 10 years, there's hardly any difference. So this 5,000 rupee difference on a 10,000 that I saw on interest rates is only this much of a gap. So even 5 years, there's hardly any difference between compound interest and so you say, "Arey, kya farak padta hai?" Farak padta hai because we all live for a long time. And that compounding over a long time is called the opportunity cost. This is my opportunity cost. If I don't invest in something which is growing like this, I'm losing this money. I'm losing this money. So this is the first concept which hits you once you understand what financial economics is all about. How our investments, our savings matter to us if they have to make any sense for us far into the future, when they really mean something. Otherwise, we're just putting money away without thinking. But when we now come to the point where we will start using that, by the time you realize, oh my God, the time is lost. And now I'm not generating enough to maintain a lifestyle which I always had during my working life. See how dangerous this problem is. And I'm dead serious. Because, now you start understanding the meaning of these concepts such as time is money. Have you heard of this? I don't want to laugh at you. I'm laughing at myself also because I'm in the same soup. Time is money. If you have time, you can do something about it. If you don't have time, it's gone. How you use your time, not only for spiritual pursuits or for anything that you do is important, but especially for money, time is critical. It is not about the investments that you do. It is how long you invest, which is important. Absolutely important. So people say, oh, in the past, people made very less amount of money, but that less amount of money compounded at a rate would have made you the richest man on earth today. So I went to Pradhan College in Mumbai, and in Ruya College, they have a list of donors. So Ruya College, I don't know how many of you know. It's a very old and respected college in Bombay, which traces its history for many years. My mother went to do her BA in Marathi in Ruya College. So even at that time, it was an established college. But it was started with an initial donation of 10,000 rupees. 10,000 rupees, yeah, what's 10,000 rupees? You built a big college out of that. 10,000 rupees then was almost like, I don't know, 100 crore today. Because that is how this inflation thing works. This is how it works. So any sum of money at any point of time is fine. What I do with it and how long I compound it is all what matters. Can I make it a significant sum? And over time it becomes significant if you know how to do it. So essentially what I mean is then how do I calculate the value of any investment? What is the present value? Now this is where the mathematics gets a little complicated, but I'm not going to dwell on it too much. So just keep with me. So essentially this cash flow that I'm talking about. So this cash flow I get is 1,000 rupees. Okay. So this cash flow I divide by the rate of inflation. This is what I called as a discounting rate. Now earlier you remember we called it a interest rate or rate of return. Here we are talking about a percentage, a rate, but we are calling it discounting rate, which means I have to discount that earnings at a certain rate so that I know what the present value of that sum is. So 1,000 rupees at a discounting rate of say 5% will bring it down for the first year. Second year, it will compound. If I keep the rate the same, the second year, the second exponent on the second year term, it will discount at the square of that rate, which means it will become even lesser and lesser and lesser. Even if I keep the rate the same, it will discount at a higher, so the denominator here is becoming larger and larger. Your cash flow remains the same. So essentially what I'll see is 1,000, then the next number will be slightly less than 1,000, then the next number will be slightly less. And then by the time whoever, n or 10, if that n is equal to 10, I will almost come to half of 1,000. So in present value terms, 10 years from now at the rate of say 5 or 7 or 7%, it will be a half of the purchasing power of the first year. That's valuation. So when I say I give it for 10%, it's actually a lot less than 10%. This is discounted it at the rate of that inflation or whatever I call it as a discounting factor. So if I really want to know the value of something today, what do I have to do? I have to sum the future cash flows at a rate which I feel has to be discounted. And today I get the present value. Interesting concept, right? So it is very basic mathematics, but with basic mathematics, you are able to explain in today's term what this thing should be worth. So if I say that this deposit that I'm saying is worth 20,000 rupees, okay, in nominal terms, it is worth 20,000 rupees, which means I put in 10,000, but 1,000 for the next 10 years gives me another 10,000 in interest. I add back to my initial sum. I feel that this value of this deposit is 20,000. Everybody says it is 20,000 because it is going to give me so much money in nominal terms. But if I know how to discount it for the rate of inflation, maybe it is not worth 20,000. I will only make maybe 15,000 rupees on this in today's terms. So in 10 years time, I'm going to make 5,000 rupees in purchasing power parity, which is called PPP. Then I have to realize whether that is really something worth to do or not. So can I get a higher interest rate, or can I get compounding, or can I reduce the rate? It's only a mathematical concept that either I raise the cash flow number or I reduce the discounting rate, whichever way. Now we come to a very interesting concept. I told you about interest rates lowered. Now it starts to make sense. Now, if interest rates are lowering, everything is getting lowered, right? So there is a cost and there is a return, are both two sides of the same coin. So when I say interest I get is also equal to the interest I need to reduce from the discounting, right? So if interest rates are lowered in this equation, isn't that good? But if I was only a taker of interest, then lowering of interest rate actually reduces my outcome, right? So if I feel that interest rates lowering is a good thing, what am I doing? I am invested in a compounding asset. If I am interested, I'm invested in a compounding asset, lowering of interest rates is good because now I'm catching, or let's say locking the cash flow at a nominal rate which is higher. So the cash flow will remain the same on the numerator, but on the denominator, because interest rates are lowered after some time, I'm going to discount those cash flows at a lower rate. So the value of my asset just went up because interest rates went down. This is called asset pricing, financial asset pricing. And the whole thing about this is the fact that when we talk about equities, when we talk about purchase of companies' shares, it means that the future cash flows of any company that you buy, future cash flows can mean profits or cash flow, free cash flow, whichever concept you use. That entire concept now is discounted at a lower rate. And that's why Jeff Bezos made a lot of money this year, because interest rates went from, in the US, say around 3.5% to 0. So the discounting of his future cash flows, discounting of his company's profits for the next few years is almost at zero interest rates. So his enterprise now must be valued up much higher. Otherwise, there's a cost of money. So in other ways, this interest rate measures the cost of money. And as a depositor, you are a lender of money. And as a owner, you are a user of the money. Right? So what would you prefer to be? A lender or a borrower? If you are a borrower, lower interest rates are good for you. And why do you borrow? You borrow for an enterprise, for a company, because you're doing and increasing the rate of what you are producing at a higher rate than what you're borrowing. That's your margin. Right? So as a business, what does business do? Business borrows money at a rate and then puts into an enterprise which generates more income at a rate, hopefully, which is higher than the cost of money. That's why the enterprise exists. Why do businessmen exist? Because they're able to use capital to make a return which is higher than the cost of money. That essentially is business. And a successful business is when it can make a lot more money than what it needs. It can either be an idea, it can either be a concept, it can either be a service, it can be any enterprise. And that is what enterprise is. Is that enterprise threatening? No, I think it's wonderful. We should all be part of ownership of such enterprises rather than lending money to them. Because when we lend money, they will only give us a fixed, simple interest rate. But when we own them, the potential to make the future cash flows are compounded, right? But then the fundamental question comes that not all enterprises are successful. And that's where you lose your money, right? So it comes with risk. It's a much higher probability concept to put your money to work as opposed to simple. So the whole idea that I was trying to explain was, how are you investing your money, for how long, and for what purpose? So longer the cash flow in time, lower is its present value. And in other words, a sum promised a year from now is more valuable than a sum promised 10 years, because the discounting will eat into the value of it 10 years from. So if someone says, oh, I'll give you a lot of money 10 years from now, you have to be very careful, because you have to now use these calculations to figure out what is the real rate here. What is he saying? Many people get confused on real estate. People say, oh, all this financial thing is very bad. I invested, 1 lakh rupees in a flat. It's worth 1 crore now. Have you worked the compounding? At what rate has this growth of 10 times become? Over 20 years, over 30 years, over 40 years. If over 40 years you've even just done that, then it's about the same. It's about 10, 11%. It's not a big deal. And the equity markets, for example, over the last 35 years has compounded at the rate of 14%. So now, and on equity markets as an index, I'm not talking per equity. I'm saying the equity market as an index, the Sensex or the Nifty, has compounded at the rate of 14% over the last 35 years. No wonder people who are in the stock markets are very wealthy, who remain in the stock market for long. And that brings us to the fundamental question, which companies to invest in? Because some companies are much more successful and some companies die out, some companies go bankrupt. That's the risk. And the risk is reduced by making a portfolio of them so that you reduce the average risk. At the same time, you give yourself the potential to compound your return over long periods of time. So I think I've come to the end of our social contract that we should meet for about an hour. I have some other points to make, but I think we probably don't have time to cover all of that. And I'm sure you will all have questions. So I'm just flipping through the slides to give you some idea of what all we could have got into if we had the time. There are concepts such as risk, which are measured by way of volatility, and a term which I'm sure you're all scientific people, so you know what standard deviation means, how to calculate that. But what does that mean for movement of stocks, and whether the higher standard deviation gives you a sense of how volatile and how risky the stock is as opposed to some stocks which are not that volatile. Absolute risk, capital, these are concepts which I'm sure you go to a website and you'll find. But I just thought that all of this could be helpful to kind of put the germs of interest in your mind, so that pick this up forward, make learning a joyous journey like all you have done in your own fields. This is a new field, but please, I will end with saying that don't try this at home. Okay, don't try investing money right now in the stock markets. This is not for you. Learn about it, get to know that there is a science behind it, there is a concept, there is a lot of data available. Fantastic things can happen, but
Hey Google, switch off.
60 over are far ahead of the game, and we shouldn't.
Switch off.
But it's just something which can kindle interest, and maybe you can do that if you know a lot about the subject.
Switch off பண்ணிட்டா அது ஆஃப் ஆயிருச்சு. இப்போ வந்துட்டு plug எடுத்தா வந்துட்டு இது மொத்தமா முடிஞ்சது.
With that, I will come to the end of my discussion, and we'll take some questions.
Thank you very much, sir. Thanks a lot, sir. I'm sure we all have become little more wiser after your talk regarding our finances. I'm sure all will agree with me to this. Thank you very much, sir. Next in line is the storming session of questions and answers. I have the privilege of calling Mrs. Jayashree Saines, A short introduction about ma'am. Ma'am joined BRC in 1971 through training school, where she worked in molecular biology division for over 41 years. Her area of research was in photosynthesis and molecular biology. After retiring, Madam joined Ignite program to understand the technical analysis in cash market. Wow, ma'am, from molecules to cash market. Great jump. Later, ma'am will also summon up Tushar sir's talk also. So, Jayshree ma'am, are you ready with the questions of the participants?
Yeah.
Okay, ma'am, please take over.
Yeah. Actually, there are only, I can see only 3 questions. And one is from Mr. Vaidya, Mrs. Vaidya, PR Vaidya. They're saying that many are missing this masterpiece. Does USA put these lectures on their website? And if not, they should do it. So it's not for Mr. Pradhan. The other question, one is from Madhu Pava, and another from Lalita Dhareshwar. And they are saying, what are the ways for compounding the money? How to compound our investments? And that is for Mr. Pradhan.
Yeah, so I wish I had a magic wand to say this.
I'd say, yeah.
So simply, as I mentioned earlier also, that there is no compound interest on offer. So nobody will offer you compound interest, but you can impute the compounding that you have calculated by investing a sum of money in a variable return asset. What I mean by that is, suppose I go back to the year that I came back from the US, 1995. At that time, HDFC Bank, which is a company which is now very well known to us, was launched. It got the license to operate as a bank, private bank, one of the first few private licenses to be offered in this country. And the IPO price, the initial price offer for that company at that time, because it was hardly anything, it was just starting off, it was 10 rupees a share. Now that 10 rupees did not give you anything except that you own some shares. It did not give you any interest, no simple interest, nothing. But the price of that share now, if you incorporate all the bonus shares and all that, again, it's a little technical jargon, but principally that 10 rupees has become close to 20,000 rupees, right? 10 rupees becoming 20,000 rupees. Now, if I calculate 20,000 back to 10 and do the compounding, I will get to know how much I've compounded at. But you will not get that rate initially, if I'm trying explaining to you. So if you found an asset which compounded at a much higher rate, it's only when you get there do you know what the compound interest was. But no one is willing to offer. So how many such HDFC banks can you get? Zero. There's no other HDFC bank. This is the best possible alternative of that end of the spectrum. And there are other companies which, if you go back to 1995, you look up the stock prices of any of the companies today which exist, find out the price that they were trading at that time. If they survive today, there are many companies which have not survived over this last 20, 30 years. The companies which survive today, their stock price, just take price because there will be some changes that their equity may have done. They have given bonus shares, they may have done something else with their stock. So like to like, it may not be a comparison, but just take the current price. It will be much lesser compounding than actual because of all these corporate actions. But take this price today and go back to the 1995 price, compound it for that many years, and you will find out what compound return you got in that. So obviously that is the way to get compound returns. And the only simple way I can assure you is that I don't know which company to buy. Equities are the only ones which compound, by the way. There's no other thing. You can take gold, say for example. People say, oh, I made money in gold also. Compound the rate of gold and you will find that gold in India has compounded around 5% over the last 20, 30 years. It's not as high and hot as say equities. You take real estate. So these are compounding assets, gold, real estate, equities. They don't give you any simple interest, but you wait for the potential to appreciate. So the capital here is appreciating And that appreciation rate is your compounding rate. So no one is actually giving out a handout. So in equities, sometimes you even get dividends. So that's also a handout. You get that also. And on top of it, if you have selected a good company, you compound at a higher rate. But the easiest way to get interested in this compound interest business is to buy a mutual fund, an equity mutual fund, but not right now. If you have children who are in their early earnings years, 25, 27, 30 first jobs, ask them to buy a diversified equity fund and tell them to invest in it regularly and wait till they're 60. That's the best way to generate compounding returns.
Thank you. Thank you, sir. That compound interesting, you have cleared what it was, you know. Otherwise, for us, it is